Well, I'd like to thank you all for coming. This is GIC's return to Singapore. For those of you who do not know me, my name is Michael Drury. I'm the Chief Economist of McVane Trading in Memphis, Tennessee, and the Chairman of the Global Interdependence Center, which is a nonprofit based in Philadelphia, which basically holds conferences like this to have open discussions about topics which are of interest to the financial services industry and more generally to those of us who are interested in global interdependence, whether that's politics or trade or, for that matter, items like disease or water or food. We like to have a very broad consensus because at the heart of it, what GIC is it's a social network of those who like together to have a very active and open discussion. Today we're going to have 4 panels discussing the outlook for this region and the international community. But for me, the return to Singapore is particularly poignant because it was here that I first met my good friend and mentor, David Kotok, who's very responsible for a lot of what GIC has done through the years. I was going to China a lot, and I heard about this trip by this group that I had never heard of called the Global Interdependence Center, and they were going to Vietnam and Singapore, 2 places that I wanted to go. So I signed up. Unfortunately, I got the flu, and I decided not to test the Vietnamese healthcare system with the flu. And so I was very upset until I realized that I could skip the 4 days in Vietnam and just come straight to Singapore. And so that's what I did, and I met David Kotok, and we had a wonderful time, an excellent first meeting here. And he said, well, that's great. Why don't you become a member? And I did. And that was the beginning of the frog in boiling water, because first I was a member, and then he asked me to be a speaker, and then to be a presenter, to have a sponsor, to put on a seminar, then to become the assistant director of programs, then the director of programs, and then the chairman. And I still haven't figured out that the water is up to 212 degrees and that I'm done. But over soon, this is my last year as chairman, and then we'll be passing the torch. I would like to point out, for those of you that are adventurous and would like to come to our next major event, it will be in Madrid, Spain. It's featuring Charles Evans of the Federal Reserve Bank of Chicago, Peter Pratt, the chief economist of the ECB, Jose Manuel Gonzalez Paramo of the ECB Governing Council, Jaime Coronas from the Bank of International Settlements, Catherine Mann from the OECD, and a host of others, some of whom are in this room and will return. So we look forward to your interest. If there are any questions, please give them to my boss, the redhead in the back of the room, Jill Fernito, who is responsible for all things GIC. Again, thank you for coming, and our first speaker today is a pleasure to introduce Loretta Mester, who is the president of the Federal Reserve Bank of Cleveland. The Federal Reserve Bank of Cleveland is one of 2, along with Chicago, that rotates a vote every other year, and this is her off year, so next year she'll be a voting member. She was the research director at the Federal Reserve Bank of Philadelphia, a place that's very close to our heart because GIC is actually housed in the Federal Reserve Bank. They're our landlord. But before that, she held a number of other positions. I guess she started at the Federal Reserve Bank of Philadelphia after graduating from Barnard College at Columbia and then Princeton University. And with that, I would like to introduce her to have a discussion. Then she'll ask some questions. We'll have a question and answer period, and Jill will be handing the mic to those of you that are going to be asking questions. Thank you very much.
There. Here. Just right here. So thank you very much. Thanks for everyone for being here. Thanks Michael Drury and the Global Interdependence Center for inviting me to speak in their central banking series. This is great. I've had the opportunity to actually participate and attend GIC programs, many of them over the years, and I've always walked away with new insights into the global economy and financial markets, and I've also been honored to speak at 2 earlier GIC events, I'm just hoping that when the organizers invited me to be on this program, it wasn't like, good, the third time's a charm. But for my part, I really feel privileged to be here, to be part of this program, and I want to thank our local hosts for, in Singapore, for providing such a beautiful place in which to speak. Now, rather than provide a standard Outlook talk, and of course there's Q&A, so of course I'll take questions on the Outlook, I'm going to speak today about a challenge that monetary policy makers face in the aftermath of the financial crisis and Great Recession, and that challenge is managing expectations. Now, when we think about expectations in the context of monetary policy, we usually mean expectations about inflation or expectations about the future path of policy. But today what I mean is managing expectations about the role monetary policy can play in promoting a healthy economy. And while I'll focus on the Federal Reserve, I believe a similar challenge applies to central bankers around the world. Of course, the remarks I'll provide today are my own views and not necessarily those of the Federal Reserve System or my colleagues on the Federal Open Market Committee. Now, a decade has passed since the onset of the global financial crisis and the ensuing Great Recession, and the U.S. economy has emerged from those dark days. It's now on sound footing. But it did take a set of extraordinary actions outside the realm of normal monetary policy to get us back to this point. And because of the pain they caused, the global financial crisis and Great Recession rightly shined a bright light on the role of central banks. People who had never heard of the Federal Reserve before the crisis now hold strong opinions. There's been a healthy debate about the role monetary policy might have played in the run-up to the crisis, the effect of non-zero interest rates on the economy and financial markets, and the efficacy of the non-traditional tools used to address the Great Recession, including purchases of mortgage-backed securities and longer maturity Treasury securities. Now, some critics of the Fed believe that monetary policy was excessively accommodating and a key driver of the conditions that led to the crisis, while other critics believe that the economy could have emerged much more quickly from the deep recession had monetary policy reacted differently. On the other side, there are fans of the Federal Reserve who believe that the non-traditional actions taken by central banks were very successful. So successful that policymakers should consider expanding the use of monetary policy beyond its typical purview. Now, in my view, both sides represent exaggerated expectations of what monetary policy can achieve. And this distorted view is troubling because it makes it harder for the public to understand the rationale for policymakers' decisions and to evaluate their performance. It's no secret that there are several legislative proposals to change the way the Fed pursues its congressionally mandated monetary policy goals. Some proposals seek to restrict the Fed's ability to pursue these goals in a way that's insulated from short-run political influence. And this restriction on monetary policy's independence would be a significant loss for the nation because as a substantial body of research and actual practice indicate, when a central bank formulates monetary policy free from short-run political interference and is held accountable for its decisions, better economic outcomes result. Now, accountability must go hand in hand with independence. That's why I believe it is time to recalibrate expectations about what monetary policy can achieve. The public needs to know what it can reasonably hold monetary policymakers accountable for. Indeed, even those who set policy would benefit if we kept in mind the serenity prayer. Give me the serenity to accept the things I cannot change, the courage to change the things I can, and the wisdom to know the difference. So for the rest of my talk, I'm going to elaborate on what this serenity prayer means for four aspects of monetary policy. How monetary policy should address business cycle fluctuations, monetary policy and long-run growth, monetary policy vis-a-vis fiscal policy, and monetary policymakers' projections of the economy and the future path of policy. Now, at times during the recovery, the public discussion seemed to suggest that by setting interest rates appropriately, monetary policymakers could offset the deep shock that afflicted the economy and speed up the recovery. But this view ignores lessons from modern economic theory and historical experience. When a shock hits the economy, it takes some time for businesses to adjust their prices and for households to adjust their behavior. This delay allows monetary policy to affect the real side of the economy, output growth and employment, providing a bit of a cushion against the shock. However, it's a temporary effect that lasts only until prices adjust and the shock dissipates. We don't know the exact timing and magnitude of that impact. Moreover, we can't predict with much accuracy the future shocks that will hit the economy. So attempting to fine-tune monetary policy to counteract the effects of a variety of temporary current and future shocks, some negative, some positive, is likely to lead to less economic stability rather than more. In addition, not all shocks are transitory. Well-known research by Ken Rogoff and Carmen Reinhardt documents that recessions associated with financial crises tend to be deeper and more prolonged than other types of recessions. The loss in output after financial crises is usually not fully recovered. In the case of the Great Recession, the housing crash required a large shift of resources out of that sector. And some Cleveland Fed research indicates that it typically takes the economy a long time to recover after a housing bust. In other words, some part of the shock that caused the Great Recession was likely permanent or very persistent rather than the type of transitory shock monetary policy might temporarily cushion. Given the size of the shock, it took a long time for the economy to adjust. Monetary policy could not be expected to make up for that permanent loss. That said, this doesn't mean that monetary policy should be unresponsive to changes in economic conditions. Monetary policy can ease the transitions the economy has to make after shocks hit by responding in a way that fosters monetary policy's longer-run goals, which for the Fed are price stability and maximum employment. This means policy will vary over business cycles as economic conditions change. For example, suppose there's a negative shock to aggregate demand. Firms will begin to cut their supply and reduce investment and employment. As output and employment fall and demand and supply rebalance, the market level of interest rates will also fall. So long as inflation is near target, monetary policy makers would want to accommodate that fall in the market rate, supporting the economy's return to equilibrium. If policymakers didn't reduce the policy rate, prices would have to fall further, and this would lead to disinflationary pressures, which is counter to promoting price stability. Or consider a positive shock to productivity growth. In this case, firms would respond by increasing output and investment, and this would lead to a higher equilibrium interest rate in the economy. So long as inflation was near target, the central bank would want to raise its policy rate as the market interest rate rose. A failure to do so would allow inflationary pressures to build. In both of these cases, monetary policy isn't attempting to totally offset the shock. Instead, to foster price stability and maximum employment over the longer run, policymakers are moving the short-run policy rate consistent with changes in the equilibrium interest rate as the economy adjusts to the shock. Notice that in this view, the maximum employment benchmark for evaluating the performance of monetary policy is not static. It depends on the types of shocks that hit the economy and the time it will take for the economy to adjust. In terms of our serenity prayer, it's important to have the serenity to know that there will be shocks to the economy that monetary policy should not attempt to offset, and the courage instead to set policy to promote the long-run goals of price stability and maximum employment. My second topic is long-run growth. The recent discussion among economists and others about long-run growth has led some people to overestimate what monetary policy can achieve. A long-standing economic tenet is that while monetary policy can affect real growth in the short run, it cannot affect the economy's long-run growth rate. Unfortunately, this distinction between short-run and long-run effects has become somewhat muddled. So let's take a step back and consider the drivers of long-run growth. The amount of goods and services an economy can produce depends on the amount of capital and labor it has, its inputs, and how productively it can combine these inputs to create output. For the economy to grow, there needs to be an increase in labor or capital, or an increase in productivity, or both. Labor force growth is largely determined by demographic factors like the birth rate, age distribution, and immigration. Labor force growth, along with labor force skills and the economy's infrastructure and institutional arrangements, such as the rule of law and well-developed financial markets, can all affect the quantity and quality of inputs and therefore the level of output a country can produce over the longer run. But sustained increases in output, that is, long-run economic growth and increasing standards of living, are determined by productivity growth. And productivity growth depends on factors like investment in human and physical capital and R&D that yields innovative products and processes. It's these underlying fundamentals and not monetary policy that determine the economy's long-run growth rate and sustainable unemployment rate. In economist terminology, in the long run, monetary policy is said to be neutral with respect to the real side of the economy and to affect only the price level and inflation rate. The FOMC statement on longer run goals and monetary policy strategy, which was adopted in 2012 and reaffirmed each year since, recognizes this distinction. It clearly says that, quote, the inflation rate over the longer run is primarily determined by monetary policy, and hence the committee has the ability to specify a longer run goal for inflation. In contrast, the maximum level of employment is largely determined by non-monetary factors that affect the structure and dynamics of the labor market. These factors may change over time and may not be directly measurable, end quote. It's true that poor monetary policy can inhibit the ability of the economy to achieve its long-run growth potential, but by promoting the long-run goals of price stability and maximum employment, monetary policy can contribute to the economy's ability to reach its long-run growth rate, even though it cannot affect what that long-run rate is. Now, while monetary policy can affect the economy's long-run growth rate, it cannot ignore it either, because the economy's long-run equilibrium real rate of interest, that is, the rate consistent with stable prices and maximum employment over the long run, is determined by the long-run growth of consumption and therefore of output. A sizable shock to the economy can affect the potential growth rate, and monetary policy will need to take that into account. The financial crisis and Great Recession affected not only aggregate demand, but also aggregate supply. Potential growth fell, and with it so did the economy's equilibrium interest rate. There's ongoing research into the mechanism through which large shocks might affect potential growth. Regardless of the mechanism, the fact that potential growth fell had implications for monetary policy. The Fed's policy rate has been lower than what it would have been had there been no change in the equilibrium rate. The lower equilibrium rate is reflected in the FOMC's economic projections. For example, in January 2012, the median level of the longer-run Fed funds rate was 4.25%. In the most recent projections in December 2016, that level is 3%. And an easy way to see the effect of lower equilibrium interest rates is to look at simple monetary policy rules that are often used to assess the degree of monetary accommodation. Now, I don't believe that monetary policy should be set mechanically using a single policy rule. No rule works well enough across a variety of economic models in a variety of economic circumstances. But I do find it useful to look at the outcomes of an array of simple, robust monetary policy rules as a gauge. And you can find updates for a set of 7 rules and their outcomes across several forecasts on the Cleveland Fed's website. The equilibrium interest rate is a parameter in most of these rules, and when it falls, so does the policy outcome from the rules, indicating that policy should respond to changes in these fundamental aspects of the economy. But this is different from trying to actively use monetary policy to affect the longer-run growth rate of the economy or the longer-run unemployment rate. As Chair Janet Yellen said in her press briefing after the December FOMC meeting, this is not a strategy she has recommended, and in my opinion, rightly so. I'm very doubtful that monetary policy could be targeted to spur a strong pickup in the types of investment in human capital and physical capital that would raise productivity growth. Monetary policy is a blunt instrument, and despite very low interest rates, we certainly haven't seen that type of effect during this cycle. Indeed, one of the conundrums has been the low productivity growth rates we've been experiencing. Attempting to use monetary policy to spur productivity growth would be a risky experiment, both in terms of our ability to achieve our longer-run goal of price stability and in terms of financial stability, given the excessive accommodation such a strategy would require. So once again, we need the serenity to accept that monetary policy cannot affect the economy's long-run growth rate, and the courage to keep monetary policy focused on what it is capable of achieving, price stability that promotes maximum employment. Rather than monetary policy, other forms of economic policy are better suited to affecting the fundamentals that drive productivity growth and potential growth. Policies and programs that encourage higher levels of investment in R&D and innovation, that help workers displaced from jobs because of technological change or globalization to transition to other jobs, and that spur investments in education to help people gain the skills needed in the modern economy, all have the potential to raise productivity and longer-run growth. Tax code changes, immigration policy, and trade policy also have the potential to affect the economy's longer-run growth rate, but whether in a positive or negative direction depends on the particular changes that are made, how they're implemented, and how they're financed. Government spending and tax policies fall under the purview of fiscal policy, not monetary policy. The distinction is important, yet it has become somewhat muddled in the aftermath of the crisis. During the financial crisis, the Federal Reserve established some special credit and liquidity programs that went beyond traditional monetary policy. Some of these programs, like the Term Auction Facility, which auctioned longer-term credit to depository institutions, were related to the Federal Reserve's role as lender of last resort. Other lending programs targeted specific markets, like the commercial paper market. In addition to put downward pressure on longer-term yields and to support the housing market, the Fed purchased large volumes of housing agency debt and agency-guaranteed mortgage-backed securities. These purchases had the desired effect of adding accommodation once the traditional tool of policy, the Fed funds rate, had reached its effective lower bound. But they also entailed the Fed's allocating credit to a particular sector, housing, something the Fed traditionally has not done. These programs were necessary, but they did have some negative aspects. One was that they opened the Fed to requests to aid other industries or to use its balance sheet to fund government initiatives. During December 2008, as Congress debated a bailout for American automakers, several members of Congress requested of then-Chair Ben Bernanke that the Fed lend directly to auto companies. Needless to say, the Fed was reluctant to go down this path, which would put it squarely in the midst of industrial policy, a responsibility of Congress. More recently, the 2015 Fixing America's Surface Act, or FAST Act, tapped the Fed's surplus account to pay for highways. To avoid the erosion of monetary policy's independence, it's important to bring monetary policy making back to more normal footing. The Fed recognized this need from the very start of its use of non-traditional tools. For example, many of the special lending facilities were designed to be self-liquidating as credit market conditions improved. And the Fed clearly states in its policy normalization principles that it intends in the longer run to hold no more securities than necessary to implement monetary policy efficiently and effectively, and that the composition of assets will return to being primarily Treasury securities. This will mean a smaller balance sheet than what we hold today, regardless of the longer-run policy implementation framework the Fed ultimately adopts. The return to primarily treasuries will take some time, but it will be welcome because it will minimize the effect of the Fed's asset holdings on the allocation of credit across sectors of the economy. And it may help guard against future calls for the Federal Reserve to enter into the realm of fiscal policy. We need the serenity to accept that monetary policy and fiscal policy are distinct, and the courage to push against attempts to use monetary policy for goals that fall into the purview of fiscal policy. The final topic I'd like to discuss is the FOMC's projections of the economy and federal funds rate path. The FOMC is not prescient, nor should we expect it to be. 4 times a year, the FOMC provides a summary of economic projections across FOMC participants, conditional on the path of policy that each participant sees as appropriate. The media focuses attention on changes in the projections over the year. And at the end of the year, stories are written about what actually came to pass compared to what the FOMC was expecting at the start of the year. For example, according to the central tendency of FOMC's participants' projections, at the start of 2012, real GDP growth for the year was expected to be 2.2 to 2.7%. It turns out the economy grew at only a 1.3% pace that year, a forecast miss of around 1 to 1.5 percentage points. On the other hand, participants underestimated the improvement in the unemployment rate in 2012. At the start of the year, they projected the unemployment rate of 8.2 to 8.5% by the fourth quarter. But unemployment ended up lower at 7.8%. The FOMC also was more optimistic about growth at the start of 2015 than what came to pass, and inflation ran below projections over the 2013 to 2015 period. Now, the public has to hold the FOMC accountable for its performance, but it should not hold monetary policymakers to an unrealistic standard. To evaluate the performance of the FOMC's projections, it's important to put these forecast misses into context by remembering that forecast errors of this magnitude, both above and below actual outcomes, are the norm among economic forecasters, not the exception. Forecasting is difficult because the economy is constantly being buffeted by shocks, data are revised over time, and there is uncertainty about which model will best predict the future path of the economy at any given time. In its summary of economic projections, the FOMC publishes a table of the average historic forecast errors across various private sector and government forecasts. For real GDP growth, a 70% confidence interval around the forecast 1 year out is about plus or minus 1.75 percentage points. The forecast the FOMC made in early 2012 was within that interval. The confidence bands around forecasts of unemployment and inflation 1 year out are also wide, about plus or minus 0.75 percentage point for the unemployment rate and about plus or minus 1 percentage point for inflation. So the FOMC projection performance is quite reasonable by this metric. Similar scrutiny has been applied to changes in the policy path that the FOMC includes in its projections. A small change in the path can generate many headlines, but we should expect the policy paths to be responsive to changes in economic conditions and changes in fiscal and other government policies to the extent that they change the outlook. Changes in appropriate policy that are based on sound monetary policymaking principles and are systematically related to changes in underlying conditions that affect the median-run outlook provide useful information on the Fed's reaction function, helping the public better anticipate how the Fed will change policy when economic conditions change. As a way to convey some of the uncertainty around our future policy path and outlook, I've been an advocate of the FOMC's publishing confidence bands around its projections. Confidence bands will help the public understand some of the risks around our projections and remind them of the reasonable amount of variation to expect in outcomes relative to projections. The bands will also illustrate that while the dispersion across FOMC participants' projections of the policy path often get a lot of attention, this dispersion is actually quite narrow compared with the confidence bands. Confidence bands will also be a helpful reminder to the policymakers themselves of the uncertainty we constantly live with. So we all need the serenity to accept that policymakers aren't prescient and their forecasts will change over time, and the courage to hold policymakers accountable for being principled and systematic in how they react to changes in economic conditions. In summary, I am a strong supporter of insulating monetary policy decisions from short-run political considerations. Accountability must go hand in hand with such independence. For the public to be able to hold policymakers accountable for their policy decisions, it must understand what it is appropriate to expect from monetary policy. Today, I talked about 4 areas where expectations need some recalibration: how monetary policies should address business cycle fluctuations, the relationship between monetary policy and long-run growth, monetary policy vis-a-vis fiscal policy, and monetary policymakers' economic and policy path projections. The Serenity Prayer provides some guidance for that recalibration. We need the serenity to accept the things that cannot be changed by monetary policy and to look for more appropriate solutions. We need the courage to change the things we can by keeping monetary policy focused on its longer-run goals of price stability and maximum employment. And we need the wisdom to know the difference. Thank you for your attention. And now I think we have time for questions. So happy to take them on this talk or on the economy outlook or on any other things you want to talk about.
Madam President, that was an impressive speech. Thank you very much. A couple of points on something that maybe we can add, and I will be very interested in knowing your response. First of all, the potential growth. You were mentioning the fact that central banks should know what the potential growth is or have a view about it, but it's not the other way around. You could not actually influence the potential growth. Well, I would sort of take a bit of a issue in that, in the sense that, for instance, how about transmission mechanism of monetary policy? I mean, you want to have an active role in pursuing the fact that your signal will eventually get to the financial system. This is a problem in Europe.
Right.
My answer to you, my sort of question to you is there an issue there in the United States? The second question is more related to one thing that also I was presumably interested in knowing more your view, because there was not sort of some word on the international environment, so the international arena. Particularly, we are now in this setup here. So that would be very important. It seems to me that the Fed is looking more into these international issues. So the episode of 2015, the renminbi Chinese stock markets, was actually a sign that, in fact, you are looking more into that. So just some comment on the extent in which actually, looking forward, the international environment will be more important in your determinations. Thank you very much.
So, excellent questions. I would say that, right, I think the distinction you're making is between short-run potential or short-run growth and long-run. So you're right. If the transmission mechanism policy is disrupted, that might have an effect. But what I'm talking about is sort of the long-run potential growth rate of the economy, and their monetary policy is not going to have an impact on that. So there have been some people who have advocated trying to sort of run the economy hot as a way to sort of bring some of the long-term unemployed back to work, and that would then increase the potential growth rate of the economy. And that's where I think that just doesn't seem to be a mechanism that you want monetary policy to attempt to do. I think that's a very risky strategy, because you would have to be excessively accommodated for quite a long time to generate that impact. And then you would basically be missing on your goals. So again, I just don't think that we can really think of monetary policy as affecting the things that would drive longer run growth or longer run potential. But you're exactly right. When the transmission mechanism was disrupted in what we just lived through, the financial crisis, that was something that was holding back the economy reaching its potential. But that's different than actually affecting that potential growth rate in the long run. You're right. I mean, it certainly is true that during this expansion, international international elements really have, come to the forefront. So, for example, the value of the dollar and its, moving around, right, affected our, for a time, our inflation rate, although that's kind of passed through. And that's something that the Fed, of course, was very attentive to. It had an impact, of course. The oil price shock, again, had an impact on our economy. You could argue that that's an international effect because it's an international market for oil. So there is definitely, I would say, in just my years being in the Fed, much more realization that international and global conditions can affect the U.S. economy. I think sometimes when you talk to people that they misunderstand that we're still focused on the U.S. economy, but these developments abroad have an impact on the U.S. economy. So our focus, when we set policy, is still about price stability and maximum employment in the U.S., but we have to take into account what's going on in global financial markets, for one thing, and also the global economies. We are very attentive to we saw sort of the pullback in the Chinese economy, early, the beginning of the year last year. And again, that changed sort of the path of policy. So again, we reacted because of what the implications were for the U.S. economy. So I think you're exactly right to point out that it does seem to be taking a more center role, but I think it's because it's affecting our economy more than in the past, perhaps because we're in a more global environment than we were before.
Continuing the question on the international side, especially currency. So I agree with you in terms of monetary policy being separate from fiscal, but at the same time, when rates are so low, currency is almost perceived by market participants as part of monetary policy. So it has the same effect, but when the currency is being run from the Treasury side, that lack of coordination among all the central banks has introduced volatility as we observed in the last 2 years. So I'd love to hear your comments about interdependence and coordination of monetary policy makers on the currency front.
Well, I mean, when you think about what drives exchange rates, obviously differentials in interest rates is one of the drivers, right? And differentials in growth rates, another factor. So you're exactly right. The exchange rate is going to equilibrate, and reflect those factors. I don't think I would advocate, though, that implies that we should coordinate monetary policy. I think we need to be focused in the U.S. on what's happening in the U.S. economy and set our policy appropriately. But, we have to recognize that there are going to be feedback mechanisms then, right? So if we set our policy at what we think is the appropriate rate, that will have an implication for exchange rates, which will feed back into the U.S. economy. So it's a general equilibrium kind of framework that you have to think about when you set policy. But that doesn't necessarily mean that you should be coordinating policies to try to avoid that exchange rate from doing that equilibrium role that it plays. So you're right, we take it into account, but in the U.S. we don't target it. And the Treasury is the one who, talks about exchange rates from having, their desired level. We don't do that. We take that as part of the financial condition that we face when we set policy, knowing that it will have an impact on our economy.
Dr. Mester, I just wanted to, probe a little bit about your views on inflation. Clearly, globalization has resulted in increased trade and the ability to import deflation in some respects. Mm-hmm. Some have been arguing that we're sort of at the tail ends of that. Both we're starting to see inflationary pressures in China, which is the biggest export market or economy. But I guess behind that, what we see is a disconnect, it seems, between the goods and the services sector. I go back to the U.S. I live in Singapore, but I go back there at least once a year, and services, every year I go back, the cost of services continues to rise. So there are domestic sources of inflation, it would appear. It's just hasn't manifested in the goods sector as much, but obviously with the shift in policy, That looks to me to be a bigger risk going forward in terms of any projections around future levels of inflation. I guess there's offsetting factors as well, but curious how the Fed sort of thinking about, that changing dynamic and potentially the policy impacts that could be over the horizon on the trade side and what that means for inflation. Thank you.
So this divergence between inflation on services and goods has been going on for a long time. This is not something that's a new phenomenon. Of course, our target is general, and I just did something, I think. I touched something that I shouldn't have touched up here. All right. So I won't try to get it back because I know I'll destroy it. Our target, right, is inflation, right? And so, relative price changes, across different goods, across services, right? That's different than inflation, right? So we're targeting overall inflation. For the Fed, it's the price, PCE inflation rate. There are other inflation rates that we monitor. My view is, we did have the temporary oil price shock, which held down inflation. We had the dollar appreciation, which held down inflation. Those have passed through, right? And the trend in inflation is it's moving up. So I'm comfortable that inflation is near its goal and moving towards its goal. One of the things that I think, given where we are in both goals, I'd be comfortable with an increase in the funds rate at this point, if the economy keeps going the way it's going, and my outlook sort of builds in a gradual increase in the funds rate over time, and I'm comfortable with that. I do get concerned that I don't think we're behind the curve yet in terms of that, but if you continue delaying, right, eventually you do become behind. And to me, where the U.S. economy is, where it's, I think we're at maximum employment from the standpoint of what monetary policy can do in labor markets. And I think our inflation path is, basically we're near goal and moving toward the goal in a good way. So I'm comfortable with where we are on the goals.
I think one more question on a similar note, and I think I really liked your analogy of the serenity principle, and I'm very sympathetic that, boy, the Fed sure gets a lot of criticisms that seem excessive and expecting way too much. But I found one of the things that was most anxiety-provoking in the past year, as sort of those secular stagnation views were really sinking in, and that five-year inflation forecast was getting to all-time lows. What it felt like is that, even thinking through the serenity principle, is do central banks really have the ability to fight deflationary powers? Do they have the tools to meet price stability as a target? And I would have said, as an asset allocator, it was very much on our minds in 2016, before we saw signs of maybe fiscal stimulus helping the cause, that we were pricing the risks of secular stagnation, and that we're going to get to the end of this cycle. We're already 7 years in, and if we get to the next recession, that's going to cause another round of deflation, that this might look more Japanese than we were saying. So I guess anyway, bottom line question is, thinking within the serenity principle, what is it that's made it so hard for central banks to effectively combat price stability?
So that's a good question. I mean, I guess my own view is, and as I put the talk together, I was thinking along the same lines, is I think the shock was much bigger, and it started in the financial markets, so that means it's a much deeper, more persistent shock than people realized at the beginning, certainly than any of us realized at the beginning. And I think, we have to understand that when that happens, it affects the economy for a very long time. And so, I was overly optimistic that inflation was going to move back to target. And I thought it would move back faster than it did. And I just don't think I fully appreciated, right, until later on, like how deep that shock was. And I think that's part of it. But again, I think the Fed being patient in what he did, early on was exactly the right thing to do. You probably realize I dissented a couple of times last year when I was a voting member because I just thought that we were getting closer and closer, and I didn't want to wait too long because I do have this feeling that if we wait too long, right, we're going to be in a more difficult situation. I mean, because you can look at sort of the historical events of like soft landings, and typically what it is the Fed being preemptive, right? Meaning going before inflation's at goal, going before you're at full employment, and also coupled with positive shocks that help you. So you kind of need good luck and preemptive policy making to actually get to this soft landing. So to my mind, where the economy is now argues that we should be bringing the rate up. But no one on the Fed, I would say, is thinking about precipitously raising. If you look at that path that's in the SEPs, which is everyone's appropriate policy path, it's gradual. I think that's kind of a good way to think about it. But as you've noticed, the policy path in the markets, right, is kind of rising up to the Fed's path now. So I think we're all kind of thinking about the economy in the same way. I guess I don't accept the premise that the Fed can affect inflation. I just think it just takes a lot longer. And you have to realize that when there's shocks, it's going to delay it more. So the appreciation in the dollar, the oil price shock, which is a relative price change, right? That affects measured inflation rates. But the underlying potential, as the Fed has kept interest rates very, very low for a very long time, has been putting upward pressure on prices. And now when we talked, we go out and talk to a lot of businesses. Like I talked to a lot of businesses in the 4th District. They're all saying they're raising wages, they're raising prices now. A couple of firms have told us, they held off raising prices because they didn't think they'd stick. They raised them at the end of last year, no pushback at all from their customers. So all these signs, are showing up. So the pressures are rising. It doesn't show up necessarily in the wage data per se strongly, but even there, if you look at sort of what the pattern is, instead of 2%, we're up at 2.5%. So again, you're beginning to see it even in the measures now. And I just think this has just taken a long time. It was a really, really deep, deep shock. And I think it's just going to take longer. Okay. Well, thank you very much for your attention, and I'm looking forward to the rest of the day.